In this video, I'm sharing 33 restaurant growth secrets from brands like Cava, Sweetgreen, Shake Shack, and more that are worth over $74 billion. First, let's dive into how a focus on finance helped this Greek restaurant scale quickly with a unique, cost-efficient menu. This Greek restaurant IPO'd at $4 billion, reaching 297 locations just 17 years after being founded. And there's 7 business lessons that we can learn from the founder, Brett Schulman, if we want to succeed massively in this highly competitive restaurant industry. So let's dive right into it. First, let's discuss how Cava was founded differently than most other restaurants, because the way that Brett designed his first location enabled rapid scale from the beginning, everything from the menu to the team itself. Brett Schulman opened the first Cava location in just 2011. He was not actually a restaurant guy. He was a finance guy who partnered with food guys, meaning that there were a few key decisions that he made by taking that finance-first mentality to building a restaurant. To break them down, there were 3 things that were different about Cava's first location compared to most restaurants, which enabled them to grow so quickly and efficiently. And by the way, their expansion strategy, even beyond the first location, was a huge part of how they got to 200 plus locations. But more on that later. Anyway, the first thing to comment on is their menu strategy, because it was unique. Brett made Cava's menu strategically very small. Instead of having dozens of menu items like most new restaurants do, he chose to just focus on a few dishes and had as many shared ingredients across dishes as possible, which has a few key benefits. First, it reduced their food cost because his food waste was lowered with fewer ingredients, and it let him unlock bulk buying discounts from his food suppliers faster. Since so many of the ingredients were common across his dishes, he was using larger portions of them. This is so important because the average restaurant today is running at a 7% profit margin, meaning that for every dollar they sell in food, they keep just 7 cents in profits. But Brett's smaller menu, designed around food cost, meant that Cava has been running at over 20% profit margins from the very beginning, and these days it's closer to 26%. That means that they make over 3 times the amount of profit per order as the usual restaurant. Imagine each customer being worth more than 3 times as much to you as competitors. That's the competitive advantage that Brett got by thinking about margins from day one. And the way he's been able to achieve that is through being very strategic about the food costs of the menu items that he offers. He didn't start the usual way by adding the most popular Mediterranean dishes, kebabs and hummus bowls, and all of these other items that have a very high food cost, but are traditionally popular. Instead, what he did was he started with the popular Mediterranean dishes, which could be made even with the low food cost. And that led him to 2 categories of entrees that each have very high margins: the bowls on their menu and the pita dishes on their menu. Why? Because the main ingredients in their bowls, their most popular category, are greens like lettuce, which always have a low food cost, or grains like rice, which is about the cheapest ingredient we can find. The typical restaurant is running at 30% to 40% of every order going to food costs, while Cava gets by just spending 15% of their sales going to food costs. This is one of the reasons why they're so profitable. It's also increased their quality, interestingly enough, because it lets Brett master a smaller amount of recipes, instead focusing on getting the highest possible quality suppliers for each of the ingredients in their recipes. And that's the reason why so many of the most successful restaurant brands use this small menu strategy. From Cava to Chick-fil-A to Sweetgreen, it's this emerging trend among many of the most successful. And believe it or not, guests actually prefer and spend more money on smaller menus for a surprising reason. I used to think that it was better for marketing to have more items, since that gave customers more reasons to try a restaurant if they were looking for a specific dish that they love. But then I saw this study that totally changed my view on menu design, which showed that when given more options, people are way less likely to buy. The reason in psychology is called decision fatigue, meaning that if people are choosing between different menu item options, it's so mentally tiring for them to have to make a decision that in most cases they avoid making the decision in the first place and avoid buying.
This is why the most efficient concept in the world of restaurants that we just talked about, Chick-fil-A, has just 7 menu items. It makes it as easy as possible to select an item, and they've spent years perfecting the recipes and the ingredients for those items that they're focusing on. So that brings us to the second major difference between Cava and others. From the start, they didn't just design their concept around reducing food costs, they designed it around reducing labor costs, and then reinvested those savings back into their team. Even in 2011, Brett was optimizing for low labor costs because labor is typically another 30% of a restaurant's cost equation. And of course, it's especially key now to control with the rising labor costs and how difficult it is to hire employees in our industry. The process is the same for preparing their bowls and pita sandwiches every time at Cava. They run down an assembly line of ingredients and then add in different ingredients depending on which type of bowl or sandwich the customer ordered. Like how you build an item at Chipotle or Sweetgreen. They get very efficient with their use of every employee. They don't need as many employees to operate their average $2 million location as others do. But here's where things get super interesting. They don't just pocket all of those savings in labor as profits, they use those savings as a competitive hiring advantage. Since each employee is more efficient for them, they can afford to pay them well above minimum wage and offer many employee benefits while still running those high margins. They've done that since the very beginning at their first location because attracting team members is so critical to success as a restaurant and as a business. You may have noticed that this is exactly what Chick-fil-A does and what Starbucks does, and it's for this exact same reason. The third major difference between Cava's concept and most other concepts is that they saw themselves as a technology company from the beginning. Even in 2011, they knew how important it was to have great technology and invested over $20,000 in their founding to build a top-notch website and mobile app for their brand. Over the years, they've spent an estimated $3 million on perfecting both experiences, their website and their brand mobile app, and have even created a mobile app team in-house. This would later be key to their expansion strategy because they used the location data from the branded mobile app that their customers downloaded to plan their expansion, but we'll give you more info on that later in this video. You may have noticed a pattern with many of the top performing restaurant brands, which is that they know how it isn't enough anymore to offer great food and great service. So much of the guest experience in restaurants is now happening online. People search for restaurants online and then read reviews online and compare different experiences online and judge a restaurant based on their website online. And now their ordering experience is online and their loyalty experience is online and much of their support experience is online. But not every restaurant has millions of dollars to invest in the right online technology like Cava does, which is actually why I built Owner.com. Owner.com today is known as the top-rated restaurant marketing platform in the world because it gives restaurants everything they need to succeed online. From a strong website that drives new customers to automated marketing to their own branded mobile app, similar to what Cava has, but for an affordable monthly fee rather than needing to invest millions of dollars in their online presence. If you're interested in getting more info on that, I recommend taking a look at Owner.com. You guessed it. Okay, so now that we've covered what was so different about Cava's concept to start, the question is now, how did they use these competitive advantages to grow so fast? And there's a few things that Brett uniquely did, starting by saying no to the franchise route. Many restaurant owners think that the path to a massive business is through franchising, meaning getting other people to put up their money to own new locations of the restaurant. And it's tempting for a few reasons. Brett easily could have done that with how efficient and popular his first location was. Yet, he didn't. Why not? Before we cover why, if you found this video helpful so far and you want to continue to learn about building a successful restaurant business, then click that subscribe button down below because I post a few new videos every month like this one where I break down what is working today to build and grow the most successful restaurants based on my experience now over the past 6 years. So, to get back to why Brett didn't go down the franchise route, it was because he wanted to maintain complete control of the guest experience, to continue to drive efficiency and positive word of mouth, which meant operating the restaurants himself. So how did Brett fund the growth to 297 locations in less than 18 years, if not from franchising? Brett followed a genius two-step process where he first focused on mastering that first location to prove out the concept and how efficient he could get it. He got it to running at more than 25% net profit margins, which is 3 times as profitable as the typical single location restaurant. Then he went to investors and he said, look at how profitable we can make each unit. We're making $400,000 in profit for this restaurant that costs us less than $1.6 million to open, meaning we get a 25% annual rate of return on our investment after we get paid back on the opening costs, and that is twice as efficient as the stock market. This is how those conversations go. It's based on the efficiency of returns relative to the stock market. And then, of course, he said, eventually we'll IPO and it'll be worth billions of dollars, which actually happened. Brett got investors to buy into this plan, and Cava raised its first $3 million round just 2 years after opening from private investors. Then the team went on to continue to execute, eventually engaging private equity firms with the same promise and raising over $738 million before going public. The best part is that those investors all did well because the company is now worth more than 5 times that amount in the public markets, and it's continuing to grow fast. It's a money printing machine. There was one other thing that Cava did well, which was key to its fast growth and success, and which I see the top performing independent restaurant owners consistently do when they want to expand. And that's following a takeover growth model, rather than defaulting to building out new locations from scratch each time. When Brett felt ready to expand, he didn't do it by using all of the investor money to build out new locations from scratch, like most restaurants do. Instead, what he did was he looked for restaurants that were less efficient than his and struggling. Then he offered to buy them and convert them to Cavas. This had a few key advantages. First, it saved him massively on location build-out costs, because if you think about it, rather than needing to spend millions of dollars building everything from scratch, he used people who already had done that, and he took over their assets with his more efficient asset. The biggest example of this was his acquisition of Zoe's Kitchen back in 2013. Zoe's Kitchen was another Mediterranean restaurant that had 200 locations at that point and were moderately popular and moderately efficient, but they weren't doing as well as Cava was. So what he did was he went to them and said, let us buy your business and we'll convert it into Cava. We'll pay you a combination of cash and equity. So buying them not only saved him in startup costs, but it had another key advantage, which was taking out his biggest national competitor and leveraging their millions of customers to grow faster himself. Because Zoe's Kitchen was a Mediterranean restaurant with a similar customer profile to Cava, and they'd been around for 20 years longer. They'd had millions and millions of customers at that point, as well as marketing systems like an email list and text message marketing to contact those customers. So when Cava bought them out, Brett not only converted the locations to save on build-out costs, but his new locations had built-in customer bases of millions of people who already loved healthy Mediterranean food and were a perfect fit for Cava's menu. That was the genius in it. But how did Brett and the Cava team decide where to put each new location? How did they decide which city and state to go to next? That's where their technology company from day one strategy really paid off. Meaning that from the beginning, the team at Cava had been pushing their customers to engage with them online by downloading their mobile app. When they started growing to multiple locations, they invested heavily in even creating an in-house IT team that was primarily responsible for upgrading their mobile app from scratch. And one of the key things that they built into their mobile app was location services. You might be wondering, Adam, what's location services? If you've ever downloaded an app, you know what it is, because it's that part where it asks you if the app can use locations. But where is it useful in growing a restaurant? Well, imagine being able to see the location information of all of the customers who have ever interacted with your business. That's where things get really powerful when you're planning to expand, because you can see the cities and the neighborhoods that your customers already tend to be in. Rather than having to start from scratch in becoming known in every city, you can strategically expand into the cities where your customers are already spending time and then serve them there too. But also filtered for another important factor, median household income. As he grew Cava, Brett noticed a very interesting pattern. New Cava locations did best in upper middle class urban neighborhoods. The typical area that Cava locations get opened in has a population of 115,000 people today, with an average income of $93,000. So what he did was he looked at the neighborhoods where his customer base was already active and then filtered it by checking the demographics of that neighborhood to match what he knew would lead to a successful reception of his locations. And then he would pull the trigger on cities only where he had lots of customers spending time there already and that were the type of upper middle class guest who loved his concept. Too often restaurant owners are forced to guess about where new locations will work and bet the entire company on it. But using this data-driven strategy is key, Side note, this is why my company at Owner.com have built the ultimate customer data platform for restaurants. Not only collecting the data from each customer, but helping them use that data like Cava did to increase sales and expand to new locations.
Now, let's turn to a popular burger restaurant that started in a hot dog stand and used a webcam to create unique social proof. Shake Shack reached over 300 locations and $5 billion in valuation just 20 years after being founded, as the millionth burger restaurant in the United States without ever franchising. So, how'd they do it? That is what we're going to talk about, because there's 7 secrets that we can learn from their success in building our own businesses. Let's dive right into it, starting with lesson number 1, starting small strategically. Danny Meyer chose to put Shake Shack in a tiny location that was just 900 square feet. It was a pop-up space next to the park. It wasn't even intended to be a full restaurant space, and that ended up being a secret to their success. It wasn't because Danny Meyer, Shake Shack's founder, couldn't afford a bigger space. He was already an extremely successful restaurateur and multimillionaire who owned 10 of the most popular restaurants in New York. Yet he chose to put Shake Shack in as small a space as possible because he knew what the smaller location would mean for his business. Meaning that when a restaurant space is small, even just having a few customers in at a time makes it look very busy to people passing by. And in those early days, that meant that they could immediately have a line outside at all hours, since there was no space inside for customers to sit or wait in line. So people had to line up outside in order to get their food. That created huge amounts of social proof. People passing by would notice the huge line and think to themselves, wow, what's going on over there? That place must be really good, because they always have a line out the door. Then, as the restaurant caught on, the line got bigger and bigger and bigger. Eventually, this became the ultimate free marketing tool for Danny. Not only did Danny get the original location size right, but he had another genius idea to make sure that he became known for that line outside the door, which was actually lesson number 2, using new tech as a competitive advantage. Danny invested over $50,000 from the beginning in creating a custom website for Shake Shack. And in 2004, that was a very rare thing to do. But his tech strategy didn't end there, because as soon as he started having those lines outside his door, which was pretty fast given the small space, he put what's called the Shack Cam on his website, which was this experimental new technology that live streamed a feed during his open hours. He said the reason was so that people would know how long the line was and how long they'd have to wait for Shake Shack. But from a marketing perspective, this had a huge benefit, which is that even people that were discovering his concept online immediately saw the social proof of having a huge line outside the door. So you might be wondering, Adam, what if I don't have a line outside my restaurant? And what if I haven't chosen a strategically small space? Is there a way I can use this? And the good news is the answer is yes. There's a few different ways to use this same psychology to make your restaurant more popular. Here are the ways that I see work best. First is having a featured reviews section on your homepage if you don't already. The best reviews to show off are the ones that either talk about how great your experience consistently is, generally, or that talk about how much they love a specific dish that you're trying to sell more of. Having a section like this where people can quickly see reviews of your restaurant increases how many website visitors end up placing online orders or going in person, because it's so psychologically powerful to see what other people think as you're evaluating a restaurant. 70% of people check online reviews before placing online orders. So if you can control the ones that they see, you increase the odds that they end up picking your restaurant. The other system I see working really well for this is placing a like counter or a popular tag on menu items themselves, either on the online menu or on the online ordering system. This helps because people can then see what other people like. And when they see a dish is especially popular, it makes it that much more tempting to try that dish on their first order, and they become that much more intrigued to order from you. We see conversion rate greatly increase when there's that social proof as part of the online ordering experience. You may have noticed that DoorDash is the one that made this system popular, but it also works really well if you could build it into your website or your online ordering system to increase sales for the same reason. Speaking of increasing sales, if you want me to check out your restaurant's website and comment ideas on how to tweak it to drive more sales based on what I've seen, then just comment your restaurant's name and city below. I will completely for free take a look and share ideas based on what I've seen work best, helping thousands of restaurants with their their websites over the past 6 years. So back to Danny Meyer. Danny's investing in new technology didn't end with his website. He famously created one of the very first branded mobile apps for Shake Shack, way before every other large restaurant group did. And it cost him millions of dollars because he partnered with Olo and a custom development agency called Fuzz and hired internal developers to continuously tweak and create the perfect online guest experience for him. It was a bold move, but he knew that it was worth it because of this next lesson, which is lesson number 3, protecting direct customer relationships. The reason Danny invested so early and aggressively in having his own app is that he saw what was happening to his friends in the hotel industry. At first, travel apps like Expedia seemed great because they promised new incremental business and their fees were reasonable. So hotels agreed to start using Expedia and all of the rest. But then they saw more and more of their existing customers being cannibalized by Expedia, who wouldn't even share their info anymore and whose fees got higher and higher, wiping out that hotel's profit margin and control over their customer relationship. And many of the independent hotels were put out of business by this effect. Sound familiar? To Danny, it did. And so even as Grubhub was getting big in New York City in the mid-2000s, right in his backyard, he made sure that he owned his customer relationships online and didn't become dependent on third-party apps. That meant pouring millions into having his own Shake Shack app to play a huge role in that. He also realized that it would do more than just make his business more efficient by saving him on those fees or saving him the customer relationships. Because when he went to raise money for Shake Shack in the early days, which is how he expanded without franchising, he was differentiated to investors through being so tech forward. They would see he had a top tier website and his own branded mobile app and a huge database of online customers who had that app installed, and that meant location tracking and push notification to all of those customers. So investors would be much more excited about backing his business because of the strong technical foundation that he built. Location tracking through his own app was also a strategy that he could use to figure out where to put new locations based on where customers tended to be. He could see their locations. And push notifications allowed him to instantly surge sales through sending alerts right to people's devices in a format that is read 40 times faster than email. So when he pitched investors to fund opening new locations, they knew that he had a base of hundreds of thousands of engaged customers to de-risk their investment. And he was constantly running promotions and running incentives which reward people for having his app, so that base only grew over time, and today it's one of the top restaurant apps in the entire app store. Here are some of the incentives that I've seen him use. He offers exclusive menus for downloading his app or ordering directly from his online ordering system. The most popular one is called the hot menu. The only way you can order the hot chicken sandwich or the spicy cheese fries from Shake Shack is through downloading their app or placing a direct online order. That's how they've gotten millions of installs and over 500,000 5-star reviews in the app store. If you're thinking, this sounds great, Adam, but I don't have millions of dollars to invest in my own app, then I have great news for you. Because we've spent the past 6 years studying what Shake Shack and Chipotle and Sweetgreen have done and what's worked so well for them in order to create technology that enables independent restaurants to have their own app. It integrates with restaurant point of sale systems and then gives you your own app, which makes reordering take just seconds for regulars and gives you those same location tracking and push notification abilities that so many top apps have. So if you want to take a look at that, then visit Owner.com to see a demo. Anyway, another key to Shake Shack's success has been their unique approach to recruiting. That is the next lesson. Lesson number 4, the 51% rule to team building. Danny Meyer, Shake Shack's founder, has trained all of his managers and leaders to pick employees based on this rule, where he says that 51% of what they look for in team members is mindset and only 49% is skill set. That's very different from what I see most restaurant operators do, which is they look first for skill set in the form of experience and a relevant background, and then mindset is kind of an afterthought. What Danny asks himself as he is interviewing his team is, can this person empathize with others? Does it seem like they get things done and show up to work with a positive attitude? Not, does this person have the skill or have they been a line cook before? Because his attitude is that skill is easy to teach, but empathy is not. He calls the other thing he looks for the excellence reflex, meaning he asks himself, does this person care about excellence in the things they do? And then once he recruits those people, he treats them like gold. Secret 5 is treating employees like gold. Notice that I didn't say pay employees employees like gold. Because interestingly, Shake Shack doesn't pay employees much higher than usual fast casual brands do, even though they're a much more profitable than usual restaurant. What they do instead is they create an environment which makes employees feel valued at work. For example, when new employees would join Danny's team, he would do an orientation lunch with all new employees every month where he'd get to know them as people and make them feel valued. He was also early to set up a shared calendar system, which made it easy for his team members to swap shifts and give them that flexibility. He also gave them a 60% discount on food, basically just charging them the food cost so that they could eat whatever they wanted at work affordably, and created kickoff meetings in the morning where they would get to review what was working and what was not working to focus on. This created an environment where people felt that management cared about them and was invested in them growing, which in turn led to much higher levels of service and employee retention. Those levels of service helped create the brand reputation that Shake Shack's become known for. But that was only part of that brand reputation, because that's actually the next lesson and the biggest secret to Shake Shack's success. Secret 6, building brand from the beginning. Danny had seen the power of brand in his other restaurant concepts, so he invested heavily in it from the start at Shake Shack. It's how he was able to charge more than double what McDonald's charges, even though he had a smaller storefront and a very similar menu. It started with him knowing exactly who his target customer is. Upper middle class men in their 30s and 40s. That is Shake Shack's target demographic. You may think that a burger restaurant should try to be loved by everybody, but that is a losing strategy, because all of the restaurant brands that have succeeded over the past 30 years are loved by some and hated by others. In the case of Shake Shack, their first location was at Madison Square Park, right across from all of the office buildings. And those office buildings had high-income tech workers in their 30s and 40s working in advertising on Madison Avenue or in tech. And Danny has this great quote about his restaurant building strategy, where he says that when a restaurant can serve as an unofficial club for a group, that it takes on additional mystique and leads to more and more business. So he set out with that Shake Shack location to build the unofficial club for those high-income tech workers in their 30s and 40s right off of Madison Square Park. And step 1 was focusing on his ideal customer. Then what he did next was genius. He realized that to stand out to those people like a club, that he needed to align with what they thought was cool. And he realized that they thought two things were cool: the 1950s period of greasers and tech. The name Shake Shack actually came from the movie Grease. It's mentioned near the end when John Travolta and Olivia Newton-John sing "You're the One That I Want." They mention Shake Shack as the ride they're on. He knew that some people would get the reference and think it was cool, particularly the advertisers on Madison Avenue. And in that theme, he created a layout and interior design and signage which felt like a 1950s burger spot. But he also knew that there was another thing that his target customer found cool: tech and the future. So he aimed to make it feel futuristic at the same time. That's where they got that future-looking Shake Shack icon, and why the illustrations on their packaging look so techy even though it's got a 1950s theme. Those people who were his ideal customers saw Shake Shack as being a super premium, cool option that felt almost like a club to them. Here's where things get really interesting. Shake Shack today has become known for their gourmet food, like their freshly made crinkle-cut fries or Korean burger options. But in the early days, the menu was super similar to McDonald's and Burger King. Their fries weren't even freshly made at the time. For years, they were just like McDonald's and Burger King, frozen fries, and they were still able to charge double or triple for their milkshakes and their fries. Imagine what happens to your expansion budget if you're able to charge double or triple the usual rate and yet have a very similar food cost to McDonald's or Burger King. You make more than double the amount of profit per order. And on top of that, Shake Shack had lower build-out costs with that tiny 900 square foot location, no in-store seating, minimal signage, and a similar menu to McDonald's and Burger King. The reason for that is brand. Customers saw the cool packaging and felt at home with the 1950s theme and the futuristic vibes, and immediately that signaled to them premium, cool experience. They said to themselves, wow, this place looks cool. Secret 7, premium pricing power. Danny could have thought to himself, we're going to price the same as McDonald's and Burger King, but offer a better product, because that will mean more customers and winning more sales in the long term. Better product for cheaper, or better product for the same price. I see restaurant owners fall into this trap all the time, but there's important research which proves that it's a mistake. and it actually comes from the wine world. They've done studies on how people rate wine quality, where they put the $2 wine in the fancy $100 bottle and the $100 wine in the $2 bottle. And what they find every single time is that people always rate the $2 wine as being higher quality than the $100 wine if they think it's coming from the $100 bottle. The lesson here is that price can lead to people thinking of a product as being higher quality, and brand changes the price people are willing to pay. That's why Danny Meyer invested so heavily in brand from the beginning. Not to say that his food wasn't quality, he was also passionate about the culinary part and able to provide gourmet food. They knew who their customer was, that tech worker in their 30s or 40s on Madison Avenue, and they created an experience which they saw as premium. So if you're building a restaurant, it's key to know who your customer is, create an experience which makes them feel at home and like they're in a club where they belong, and then be willing to charge more than market prices so that people use that higher price as a signal for quality and incorporate it in how they rate your food and rate your restaurant, while giving you higher profit margins. Anyway, let's summarize the business secrets behind Shake Shack's success. Secret 1 was selecting that strategically small location to create the line out the door effect. Secret 2 was using new technology early, specifically the Shack Cam and the branded app. Secret 3 was protecting direct customer relationships, but instead creating an app experience that customers prefer to use over the delivery apps so that they're able to maintain those direct customer relationship and use them as an asset for expansion and fundraising. Secret 4 is recruiting for mindset over skill set. Secret 5 is treating employees like gold. Secret 6 is building brand from the beginning. And Secret 7 is premium pricing power. Anyway, I hope you enjoyed this video. If you did, I post multiple new videos per month on the secrets of growing a restaurant business in 2024. So if that sounds interesting to you, then click that subscribe button down below, because in addition to Shake Shack's story, I've studied thousands of other restaurants, both independents and large corporations, and I'm constantly sharing the biggest learnings from their success stories so that as you're building your restaurant, you can incorporate those secrets to create similar success. Next, let's look at how this salad chain used tech and a mission-driven approach to grow fast and without ever turning a profit. This salad restaurant IPO'd at $5 billion, reaching over 200 locations just 15 years after being founded by a 22-year-old college student. The craziest part is that they've never made a profit, losing $100 million last year alone. Yet they're still seeing massive success. That's why in this video, we're going to cover the story of Sweetgreen and the 7 lessons we can learn from the 22-year-old founder, Jonathan Neiman, to succeed in the highly competitive restaurant industry using these unusual moves. I'll also give you the secrets he used to raise $600 million from investors before his IPO, and how he expanded to so many locations so fast that you can use as well. So let's dive right into it. First, it's important to understand how Sweetgreen was founded differently than most other restaurants, because the way that Jonathan designed his brand set him up for massive scale from the beginning. That's lesson number 1. Building as a tech company first, not a restaurant company. You may be thinking to yourself, Adam, I don't want to start a tech company, I want to start a restaurant company. And it can sound confusing to start thinking like a tech company from the beginning. So if that's confusing to you, stay tuned. I'm going to break down exactly what it means and how it changed his strategy, and how you can change your strategy in building your restaurant business as well using these lessons from Sweetgreen. And even if you don't want to build a tech company, there's key secrets that you can learn to attract investors and attract talent that you're going to hear in these 7 tips based on Sweetgreen's success that you can apply even without this mindset. The story starts back when Jonathan was in college at Georgetown in Washington, D.C. He was really excited by the world of tech companies because companies like Facebook and YouTube were just starting to blow up. In being fascinated by that tech world, he realized something interesting, and that is that tech companies are built for where the future is going, not for where the present is today. When Zuckerberg started Facebook, there was no market for social media. Yet he saw a future where everyone used the Facebook app and created that future by building it. So Jonathan asked himself a similar question. Where is the future going, and how do I build a business that is positioned to win in that future? That's part of the way that he came up with the winning idea that was Sweetgreen. The best tech companies seem to have one more thing in common, which is actually lesson 2 to Sweetgreen's success. Solving a problem you have personally. Because when you have a problem personally, you can be sure that a lot of other people do too, and that a real solution that solves that problem will be a part of the future. So you may be wondering, what was his problem exactly? It was that he felt frustrated that no restaurant offered healthy food with convenience and an affordable price. That's how he came up with the idea for Sweetgreen, a salad concept which offered convenient, healthy food at an affordable price. Because he faced the problem firsthand and recognized a clear need in the market. He had good instincts about the best way to solve it that were informed by that personal experience. Too often, I see entrepreneurs start restaurants because they think that there's a huge business opportunity when they've never experienced the problem it solves personally. It would be like if I looked around town and thought to myself, there are no bubble tea places, and bubble tea places have great margins and low food costs and require little upfront capital, so I should open a bubble tea place. That's starting with a potential business opportunity versus a problem that I faced personally. I don't personally drink bubble tea. I don't think there's a problem personally that my town doesn't have bubble tea places, so it probably wouldn't be helpful to people if I opened one, even if it looked good on paper in terms of the business opportunity. Whereas Jonathan solved a problem that he had firsthand. Convenient, affordable access to fresh, healthy foods is what he built his business around. That's how he knew there would be demand for it and what the customer wanted. He was that customer, and he was building like a tech company. In fact, you're going to see in number 7 how he used this even more advantageously to build a huge business that attracts a lot of top quality talent. But before we get there, it's worth discussing the differences between a tech company and a traditional company. The big difference between tech companies and traditional companies is that tech companies build for the future, not for the present. Meaning that when Jonathan started in 2007, there were almost no healthy takeout restaurants. Salad restaurants weren't really a thing. Almost all restaurants were instead built around the in-store dining experience, with the exception of pizza restaurants, Thai restaurants, and Chinese restaurants. Yet that didn't stop him from creating his unique salad concept, because he asked himself, what is the future going to look like, and how can I build a business around that? He saw a future where more and more of the restaurant industry would be off-premise focused. So he built his concept around where he saw the world going, and it worked. Because as the industry shifted to being takeout heavy over the next 15 years, his entire concept was built around that, so he benefited from that shift. He even made a bold move at his first location, which ended up serving him well, selecting a very small space for his store at just 500 square feet with no dining room. That's actually the next lesson. Lesson number 3, selecting a strategically small space. Before I get into why this was such a key to Sweetgreen's success and why you should do it as well, if you've been enjoying learning about how to build a successful restaurant on this channel and you want to continue getting the latest strategies that are working today for doing that, then tap that subscribe button down below, because every week I post new videos detailing what I've learned in helping thousands of restaurants grow for free on this channel that you'll get if you're subscribed. Anyway, back to what was so brilliant about Jonathan selecting that small space. He selected the tiny 500 square foot space at the time because it aligned with where he saw the future going. A huge increase in takeout orders with the rise of online ordering. But it ended up having another major benefit for him: instant social proof. Because the truth is that when people pass by restaurants and they look full, they see that as a sign that it's very popular and worth trying. Man, that place must be good. Look at the line that they always have. And it's much easier to look constantly full when you have a tiny space and no dining room. People see that line and they think to themselves, man, that place looks popular, I gotta try it. Not, wow, that place is only full because they have a 500 square foot space. That is not the thought that comes to their mind. And interestingly, in 3 out of the 3 best restaurant IPOs from the past 5 years, they've all followed this pattern in that first location. Think about your own experience. When you're walking down the street and you see a street performer with a huge crowd around them, you immediately lean in and want to know what's going on. Whereas when you see that lone musician on the street that's kind of just playing to themselves, there's no urge at all to stop and see what's going on. The same is true for your restaurant. And in restaurants, it's literally cheaper to get that huge crowd by just selecting a smaller space. So it's even easier to make a profit, marketing benefit aside. When Danny Meyer started Shake Shack, he was already a multi-millionaire and owned 10 restaurants and could have afforded a huge, glamorous space for that first Shake Shack. Yet he intentionally chose a 500 square foot space, just like Sweetgreen, because he knew that always looking full and always having a line out the door would be the best marketing that he could set himself up with. And it worked. There's another brilliant thing about the economics of selecting a smaller space and designing without a dining room like that first Sweetgreen location, which is that more of your space can be dedicated to the kitchen and you don't get bottlenecked by how many people you can have seated at any given point. That means that because you have a smaller kitchen and because everybody's consuming your food outside of the restaurant anyway, that you can do a lot more in revenue and food output through the smaller resources you have. So not only is it easier to be profitable, and not only do you encourage a type of customer that ends up ordering more takeout orders, but you also are running a much more efficient use of that real estate since it's all dedicated to making food and not to the very space intensive thing of people sitting down and consuming your food in your restaurant. It also set them both up nicely for where the future was going, being mostly about pickup and delivery. There's one more key thing that Jonathan's been doing from the start, which then set him up to be such a success with investors, which is lesson number 4, investing aggressively in new technology. Jonathan didn't just take the mindset of a tech company in building for the future at Sweetgreen. He also invested like one, aggressively in new tech to be prepared for that future from the very start of his business. This meant having their own website with online ordering from the start in 2007, when that was super rare. They invested heavily not just in web design, but in search engine optimization and other forms of digital marketing, which were just emerging and helped them acquire customers really effectively. That website and SEO in turn helped them make more money on all of the early adopters of the internet who wanted to find restaurants to order from online. It also meant that they were able to figure out how to do this new online ordering thing very well before most restaurants even had it going for them, which is what led to them launching their own app in 2015. Way before most major restaurant corporations had one. Why? Because they knew what an app would do for them. Make it 10 times easier for regulars to reorder. Instead of needing to find a website every time they wanted to order, they could just open an app and go. This is why 50 out of the 50 most valuable restaurant corporations in the United States have their own branded app at this point. It's also why I've spent the past 6 years building Owner.com, which gives independent restaurant owners their own integrated branded mobile app, their own SEO, their own website that has all of these customer attracting benefits so that they can get the same benefits as major corporations like Sweetgreen spend millions of dollars to achieve without having to spend millions of dollars themselves to achieve them. Having their own app and using new tech wasn't just an asset for Sweetgreen to improve the ordering experience for regulars. It also helped them raise money from tech investors. That's lesson 5, raising capital like a tech company. The combo of identifying as a tech company, investing in new technology, and skating to where the future was going made them appealing to tech investors in the way that other restaurants aren't. And they took advantage of that by aggressively raising money from the start. From that year that they opened in 2007, raising their seed round, to the year they IPO'd in 2022, they raised $600 million before going public. When tech investors were interviewed about why they invested in a restaurant, Sweetgreen, they said it's because it's a great tech business that just looks like a restaurant business. You'll notice that Domino's has been saying the same thing for the past 10 years. And Domino's outperforms most of the high growth tech stocks like Microsoft and Facebook for this reason. This is a huge advantage because most restaurants need to rely on bank loans for expansion or private individual investors. But Sweetgreen was able to attract tech investors because they've been operating like a tech company from the start. So you're probably wondering to yourself, Adam, why should I care about all the details of raising from private tech investors? Because if you're expanding a restaurant, it's very difficult to do on just profits alone. It typically takes 3 years of profits from a single restaurant location saved up to be able to open that second location, and then another 3 years for that third location, and then another 3 years for that fourth location. Whereas raising money from private investors enables you to invest ahead without having to wait decades to reach that 10th location in the way that expanding purely from profits would force you to. As you study the success stories of the most successful restaurants founded in the past 20 20 years, whether it's Sweetgreen or Cava or Shake Shack, they all raised money from private investors or institutional investors through having a differentiated story to tell them about their growth. By raising from the private markets, they were able to expand each of them to hundreds of locations in less than 20 years, which is unheard of through just profits alone. And now you might be thinking, Adam, what about taking out bank loans? Can't that be a way to fund growth? Yes, it can, but as you know, if you've ever applied for one of these loans, they almost always make you collateralize your house personally and personally guarantee the loans that you're taking out for a business. Whereas raising money from private investors, like tech investors or private equity groups, enables you to raise in a more aligned way that isn't devastating to you personally if the business doesn't end up working out, but that enables them to share in the upside of what you're building. Having a really ambitious goal is part of being an entrepreneur, and it shouldn't require having to risk your house or personal bankruptcy in the case that it doesn't work out. By the way, if you want me to take a look at your restaurant concept today and give you thoughts on how to make it more appealing to investors, then feel free to comment your restaurant name and the city it's in down below. I read all my comments and reply to them, and I'd be happy to help by taking a look and sharing with you some thoughts and feedback based on what I've seen work best for the restaurants that do go down this route of raising private financing. And even if you don't want investors, I'll still reach out and give you some good feedback if you share your restaurant name and the city it's in a comment down below. They made another key move, which especially helped them raise from investors, and that is lesson number 6, protecting direct customer relationships. Part of the reason investors value their company so much, even though they're not profitable, is they have millions of direct customer relationships. They aren't dependent on the delivery apps, which take the customer relationship away from the restaurant and then charge them a ridiculous 30% tax on every order, which isn't sustainable to the restaurant. Instead, what Jonathan's done at Sweetgreen is create a system where most of their customers use their own app, the Sweetgreen app, to order. And they've designed a whole system around protecting direct customer relationships. Everything from their packaging to the posters in their dining room to the way they train their staff is designed to push people to order directly from them online, whether that's through their app or through their website, because they know that the most valuable asset in every business is its customer relationships and customer data. In an industry where restaurant owners are losing that advantage to the delivery apps, Sweetgreen continues to differentiate by having tens of millions of people with their app installed, with their marketing opt-in, that they can show to investors and that they can use as a company to drive additional revenue from their existing customer base. Their customers aren't being held hostage by the third-party delivery apps that then charge them a ridiculous 30% ransom on every transaction. That doesn't make for a very investable business. Instead, they have complete access to their customers. They can send them text messages or push notifications at any time with menu updates. They don't have to pay 30% on every transaction like through the delivery apps, because those customers are ordering directly from them. And they use those customer relationships to implement lesson 7, which has been maybe the biggest key to their success. Having a clear mission that is communicated to customers and sticking to it. From the beginning, Sweetgreen defined a mission that they knew would inspire customers and employees. They describe it as building healthier communities by connecting people to real local food. And they stood by this mission even when it's been inconvenient or costly for them, so people know they take it seriously. If you listen to their earnings calls today, they're constantly being attacked by public market investors, saying how costly it is to buy from local farmers. Why not just go to national distributors like Cisco? And Jonathan always responds by saying, because it's our mission to serve this local food. And the investors have nothing to say. This is how they're able to attract such great talent and such loyal customers who are willing to order directly from them. They've defined this mission that they know is hard, that they know is costly, and they stick to it. It's echoed in every part of their story, from how their restaurants' dining rooms are designed to the messaging they send out in their email campaigns, this idea of connecting people with real food. And that's what inspires their customers to be so loyal and inspires their team to love them so much and inspires investors to continue funding them, because they're creating a change that people want to see in the world. And they view Sweetgreen as the vehicle for driving that change themselves, by being a part of it.
Let's move on to another restaurant that changed fast casual dining
with a model that broke efficiency records. 30 years ago, Steve Ells started a new Mexican restaurant. He called it Chipotle, and he took it from one location in 1993 to over 3,200 locations worldwide today, making over $10 billion a year in sales. Which is why in this video, I'm going to reveal the 5 secrets that Steve used to create an entirely new dining category with Chipotle. How they sold over 1,000 burritos per day from that first location, and many more secrets that you can steal for your own restaurant. Let's jump into it. Most restaurants start by making their menu as big as possible. And the thinking goes that if you have a big menu with a lot of options, that each of those options will be able to appeal to a specific type of customer. But Steve actually took the opposite approach, because from the beginning, his goal was to maximize the amount of orders that they could do per hour, knowing that if he could reach his goal of doing 100 orders per hour, that he would beat every other restaurant on efficiency. He knew that the typical fast food restaurant was only able to serve less than 50 orders per hour at the time, and basically designed his entire concept around this assembly line approach that was able to double his throughput. To do that, he had to go in the opposite direction of having this big menu that every new restaurant seems to take, and instead base his menu around just 4 dishes: bowls, salads, burritos, and tacos. He intentionally made them dishes that had shared ingredients across all of them, and it achieved this trifecta of operational excellence, where he was simultaneously able to have low food cost, low food wastage, because he's buying the ingredients in bulk and they're used across dishes, and they simplify operations, increasing his efficiency on the labor cost and increasing his throughput so that customers get their orders faster, and so that ultimately he's able to make more money in revenue for those locations. This is so different from what most restaurants start doing. And if you've started with dozens of different menu items to try and appeal to many customers, it's not your fault. That's the conventional wisdom in the industry. What I'd recommend doing is thinking about each of the dishes you have and whether there's an opportunity to do with your concept what Steve did with Chipotle, where you simplify the menu and look for dishes that have shared ingredients that can each independently attract new customers. If you want help with this, then just comment your restaurant name and the city it's in down below, and I'll take a look at your menu, analyzing which dishes seem to be driving you the most new customers and how I'd recommend paring it down so that you too are able to achieve this operational efficiency and this super fast, convenient, high revenue throughput customer experience. There's another secret reason why this is so powerful, which is that it gives the management team this number to obsess the entire team with. And that number is how many customers they're able to serve in a single hour. I just saw this thread on Reddit where Chipotle employees are bragging to each other around how many customers they've been able to serve. And one employee from one of the Chicago branches jumps in and talks about how his location was able to get up to 380 customers served in a single hour. By obsessing the Chipotle employees over increasing the throughput per hour, they're also able to deliver this really important customer outcome of ensuring that everybody that orders gets served quickly, regardless of how many people are trying to order at once. By the way, my restaurant owner mind reading skills have gotten very good, and I can tell what you're thinking right now. If you're serving 380 customers an hour, the quality must be trash. That's why in strategy number 5, we're going to talk about the systems that Chipotle put in place to ensure quality control even when they're doing such high throughputs. But before we get there, it's really important that we cover secret number 2. What's so interesting about Steve's story is that he was able to achieve both high quality food and this incredible order volume. And the way came from this insight that he had after working in fine dining, but being obsessed with going to taquerias, where he knew the fine dining world on how to create high quality food, and also saw that the taqueria world was able to produce fast service. So he asked himself, why not combine the best of both worlds? The high quality food from fine dining with the fast service of the taquerias. And that's how Chipotle was born. And that brings us to secret 2, combining these proven concepts to create a new, unique concept as a result. Right off the bat of starting Chipotle, high quality food that was previously only available in the full service environment, and fast service that was previously only available in low quality food, fast food environments, Steve immediately had a massive success on his hands. In the first 30 days, he got to selling over 1,000 burritos per day and literally had lines outside the door of that initial location. That's the power of taking these proven concepts, which people don't otherwise combine in their minds, and getting the best of both worlds from them. If you want to continue learning about the best practices working today to grow a restaurant, then click that subscribe button down below, because every week I post a new video based on what I'm learning and helping thousands of restaurants grow, or studying the very best like Chipotle. Steve's differentiation of Chipotle didn't just stop there of combining these unusual characteristics of different concept types. He took it a step further and connected it to this trend that he saw in society, where people were caring more about doing right by the planet and doing right by their bodies. He saw that there was this movement towards health that was being accelerated by documentaries being released, like Super Size Me, and decided to connect what Chipotle was doing to that movement through taking a strong stance in his mission, saying that Chipotle was about food with integrity. One thing you'll notice about the strongest mission statements in business is that they not only relate to a trend that's happening in society, but they give you a clear enemy that the mission is positioned against. In the case of Chipotle, by saying that they were serving food with integrity, they were implying that all of these other fast food restaurants at their price point weren't serving food with integrity, and pointing out the clear health issues and environmental issues that they were causing. And they didn't just stop there in having a fancy mission statement. They made real operational sacrifices to make it clear to their customers that they were serious about this mission. For example, they designed all of their restaurants around this open kitchen concept, which exposes how food is being made to customers as they're ordering. There's clear operational sacrifices to doing this. It rules out certain forms of real estate. It's super expensive to knock down walls and have the kitchen exposed for people to see. It leads to all sorts of operational complexities in ensuring that the kitchen is visually maintained, knowing that customers are going to be constantly looking at it. But Steve decided that all of those different sacrifices were worth it because it would show his customers that he was serious about operating as food with integrity, and it worked. It created this experience around ordering that wasn't just speaking out what you wanted to a server, where you could actually see with your eyes as the chicken was being grilled, or as they prepared those avocados to upsell you for $2 scoops of guac, or any of the other differentiators that you could actually see and smell happening as you place that order. This further differentiated Chipotle as a fast casual restaurant because it took this concept that was previously starting to be pioneered by full service restaurants and having their open kitchens for guests to look into, and brought it to the lower end of the market. The other interesting thing about having such a strong mission is that it takes it from being about you to being about your guest. Most restaurants take this position that their guests should choose them because they're the best restaurant. Whereas a restaurant with a strong mission statement that's about having food with integrity and helping the planet actually gives the guest extra status in choosing their restaurant because they're voting with their dollars around this decision, this movement that's helping the planet and helping their body. And it becomes about something more than just going to the best restaurant. It becomes this status symbol in the person's identity. Many of the top brands have this same appeal. When you buy Nike, you're not just buying these rubber shoes, you're buying this association with the best athlete and this mission of making athletics accessible throughout life. Tesla is another great example of this, where there are dozens of different electric cars that you can buy today, but Tesla's mission to save the planet through pioneering this shift is much more exciting to consumers to buy. In addition to taking this strong stance on mission, Chipotle made another brilliant decision, which again made the experience about the guest, but this time it was about saving the guest money and earning the guest better value through being a loyalty customer. That's secret number 4, gamifying spending money with the brand. In 2018, Chipotle noticed a trend, which was that more and more of the consumer world was either obsessed with games or obsessed with gamified loyalty programs, like was working so successfully at Starbucks, where people were spending more money with Starbucks knowing that every time they spent money, they got more points towards free items in the future. And Chipotle decided to do the same thing through launching their loyalty program. In just 30 days time of embedding it into their app and their website, they had over 1 million customer installs using it. In the first year of launching this new loyalty program, they saw a 19% increase in year-over-year revenue, totaling $1.4 billion in additional sales. What's so exciting about this though is that it's not just huge corporations corporations like Chipotle that can see big sales increases through having their own loyalty system. I'm not saying that independent restaurants can see a $1+ billion increase in sales, but I am saying that it's proven that when independent restaurants make spending money with them gamified, fun, and rewarding to guests, that guests do it more often, just like they do with large corporations. You may be thinking to yourself, Adam, that's great and all for Chipotle, this publicly traded company with tens of billions of dollars in market cap, but will having a loyalty program even work or be accessible to an independent restaurant owner? And the good news there is the answer is a clear yes. We can see this demonstrated recently in this case study from Metro Pizza. Metro Pizza is a 4-location independent restaurant in Las Vegas that decided, like Chipotle, to modernize their guest experience and to gamify spending money with them to increase order frequency and order size. And the results they saw in the first 30 days alone were bananas. We're talking a $10,000+ lift in sales, in addition to 11,000 people downloading their app and enrolling in their loyalty program, just like happened with Chipotle. I've personally seen this happen thousands of times now with independent restaurants, where they modernize their online technology and they include a loyalty program and then see increases in sales as a result. The key to making it work, though, is ensuring that you're not giving away items that are too high in food cost or too frequently, so that the math actually makes sense. And to do that, you have to design that loyalty system, just like Chipotle, around the high margin, low food cost items. In Chipotle's case, that might be the chips and guac. In the case of Metro Pizza, a pizzeria, it'll be the mozzarella sticks or the side salad or these other items that might have a listing price on the menu of $5 to $10, but that in reality cost less than $1 to make. And that difference between the listing price on the menu and what they actually cost in food cost is entirely perceived by the guest as being amazing value for ordering directly from you. So that encourages the behavior of the guest using your app or using your website to order from you, and ultimately gets them to do it more frequently and do it in place of the third-party delivery apps like DoorDash. If you want to see that case study of Metro Pizza, then check the comment section down below. I'll pin a comment with the link to the Metro Pizza case study so that you can see before and after their numbers and how specifically they achieved that result, so that you can try and do similar in your restaurant. With all of the genius strategies that we've covered in this video, it might seem like Chipotle's journey to success has just been straight up and to the right, all sunshine and rainbows, but that hasn't been the case, because you might remember that less than 10 years ago, Chipotle was in crisis. Some of their customers were starting to get sick from E. coli, and this became a national news story. This news story dropped Chipotle sales by 30% that year and sent their stock price diving by 46%. Some people were wondering whether Chipotle was going to make it, but because of this secret, they not only survived, they got back to bigger success than ever. And that secret is secret number 5, maintaining customer trust at all costs. It would have been easy to panic from Chipotle's perspective and tell customers that you were working on it, but then not be very transparent about what steps you were taking. Chipotle took the opposite approach, where they immediately accepted responsibility for the issues that were happening and made public statements apologizing to people and saying they were going to get to the bottom of it. Then they didn't just speak those words, they took clear action to educate guests transparently on how they were evolving their food safety processes, on how they were changing how they were sourcing food in order to protect them moving forward. They put in-store signage and signage on their website, educating guests on these steps and the progress they were making. And as a result, just 2 years later, they saw a huge rebound where they'd gone from being down in sales to more than doubling their sales as customer confidence recovered, because people saw that Chipotle's mission wasn't just having food with integrity, but that they stood with integrity when things went wrong and focused on making it right. Just like Chipotle's doing this same set of steps, it's something that I'd recommend every independent restaurant get great at, because like Chipotle, there's going to be ups in your journey and there's going to be downs. There's going to be that unfair negative review that gets posted, or that ridiculous customer experience that ends up having the potential to damage the reputation. And what matters is not whether you have a perfectly smooth journey, because that's impossible, but how you respond when you get punched in the face. That's the last secret. It's much easier said than done, but if you're able to consistently do it, then when these crises come up, like with Chipotle, you're able to weather them just as well, because you're operating with integrity and with this long-term mindset that customers see in you and are more willing to repeatedly buy from you as a result.
Now, what happens when a pizza giant turns to psychology and technology to not only survive, but thrive in a massively competitive market?
Domino's sells more than 3 million pizzas every single day. So in this video, we're going to cover the top 7 psychological hacks that they've used in their marketing and in their business model that you probably will be able to apply in your business too, once you understand them. Psychology hack number 1 is avoiding decision fatigue. Decision fatigue is this idea in psychology that if you present the customer with too many choices at a time, that they become overwhelmed because there's so many different things to choose from. And as a result, don't end up buying any of them. So what Domino's does to avoid this decision fatigue is they structure their ordering experience step by step. If you open their website or their branded mobile app, what you'll notice is that they don't present you with the whole menu at first, like most restaurants do. Instead, what they present you with is just 3 options of the combo deals. And then if you don't take them up on a combo offer, you click into the full menu, they don't show you the full menu right away. What they show you is one category at a time, starting with the category that they most want you to view, the pizza category. This was interesting to me, because I used to think that it was better to provide the customer with as many options as possible. I thought that the more options that we give our customers, the more likely they are to buy from us, because the more likely they are to find an option that matches what they want. But then I read this famous study which completely changed my mind and made it clear why Domino's has set things up this way. That study happened in the year 2000, and it's about how people buy food. To set it up, the researchers, Sheena and Mark, created an experiment. They set up a booth with samples of jams for people to try in a supermarket. In one setup, they gave people 6 jam options to sample. And in the other setup, they gave them 24 jam options to sample. What was so interesting was that more people tried the jams when there were 24 options, but very few people actually bought any jams. Only 3% of samplers ended up buying in that version of the experiment. But when there were only 6 options, fewer people tried the jams, but then many more people bought them. The difference was 10 times the amount of people. When there are too many choices, people can feel overwhelmed, and it can be hard to make a decision, which then leads to lower sales. How can restaurant owners specifically apply this insight that Domino's has used to their advantage? By setting up their website, menu, and online ordering system so that people are viewing one category at a time and offering as few options as possible at any given point rather than as many as possible. On the homepage, there's a great place to do this, because rather than showing the guest your entire menu at first, you can have a section on your homepage, like Domino's does, where you just showcase the 3 or 4 most popular dishes that you want them to choose from first, rather than showing them the entire menu at once. The thinking is that if you can get them to fall in love with the pictures of one of the most popular dishes on the menu of the 4, say, that they're much more likely to want to become a customer and place a full order, because they're not overwhelmed with having to select between 15 different entrees on the menu, like the jam experiment. They've just got a few of the most popular to begin their order with, which is why at Owner.com, our website builder product has a specific feature that's built for this purpose, to show a simplified menu preview of the most popular dishes, which we recommend placing in the first section that people see after they begin scrolling, so that after they understand what the restaurant does, they can quickly see what the most popular dishes are and make that buying decision without seeing the entire menu. By the way, this actually achieves another psychology hack, which Domino's has used, bringing us to number 2, price anchoring. When I first visited the Domino's website, something jumped out at me right away. The order that Domino's is showing us the items. They're showing the most expensive combo deal as the first thing you see on their menu. They do the same on their app if you look at their mobile app. They call it the perfect combo deal and say that it costs $19.99, which is actually one of the most expensive items on Domino's menu. Now here's where the psychology comes in. There's a famous study by Dan Ariely that proves why this is so powerful. In that study, Dan wanted to see if people's decisions about how much they'd pay for things could be influenced by the number they see right before they make a decision. He asked a group of people to write down the last 2 digits of their social security numbers to basically make them think of a random number and see what effect it would have. Then he showed them some items like bottles of wine, chocolate, and computer accessories. He asked the people if they would be willing to pay the amount of dollars that matched the last 2 digits of their social security numbers for each item. For example, if someone's last 2 digits of their social security number were 42, they'd have to decide if they'd pay $42 for a bottle of wine that he showed them. That wasn't the experiment though. That was the beginning of the experiment. Because after that, he had everyone participate in an auction to bid on the items. Now here's where things get interesting. They discovered that people who had higher social security number digits of the last 2 were willing to pay more for the items than those with lower digits. What they found was that just seeing the numbers from your social security number, whether they were high or low, actually influenced how much more you were willing to pay, how much more you thought items were worth, just based on that price that you saw first. This experiment showed how our ideas about the value of things can be completely changed by something as simple as seeing a number right before it. Which also explains why it's so powerful to lead with one of the most expensive menu items first. In their case, the $19.99 combo deal at the top of their menu and their website and their app has people thinking of a very high price, $19.99 for Domino's. So then when they see the cinnamon rolls for $5, it seems like an amazing deal by comparison, or the pizza for $14 or whatever it might be. But it's one of the most successful companies in the world. Not just in the restaurant world, but in the entire world. It famously outperformed Apple, Facebook, Google, and Amazon for 7 straight years in the stock market. But it hasn't always been doing well. In 2009, it was struggling. Its growth was flat. So they knew that they needed to make a change, and they brought in a new CEO named J. Patrick Doyle, who changed their strategy from one of a restaurant company to that of a psychology and technology company. And then over the next few years, they tested thousands of things and found these psychological hacks to achieve absolutely bananas growth and success. Anyway, that brings us to the next psychology hack that Domino's actually used at the beginning of Jay's reign to kickstart their amazing growth back in 2009. Psychology hack number 3 is the pratfall effect. The pratfall effect is this idea in human psychology that when people make a mistake and then admit to it, we're more likely to trust them and like them than if they hadn't made any mistake at all. Like we covered at the start of this video, just over a decade ago, Domino's was really struggling. Their growth was declining, they had a reputation of having pizza that tasted like cardboard, which is not good, and they needed to make some serious changes to make their business work. And it was this idea that inspired their famous ad campaign back in 2009. That year, Domino's ran commercials which practically admitted that their pizza tasted like cardboard. In the commercials, Domino's showed their customers unhappily saying things like,
"Domino's tastes like cardboard with tomato paste and pepperoni on top." Yeah.
And then asked people to try the new recipe for their new pizza and give feedback.
You know what I have for you? Your comments? Help us create a brand new pizza.
That feedback started to get way more positive and constructive throughout the commercial, and they showed the process of continually upgrading and making better that recipe.
It's delicious.
That they then relaunched with in 2009. I know a lot of people still say their pizza tastes like cardboard, but the brand is killing it. We can't deny that. And the changes helped to turn around the company's sales and overall reviews and customer satisfaction. Since then, their sales per unit literally have doubled. Their sales continue to grow at 10% per year, which is incredible at the scale that they've reached, doing multiple billions of dollars in sales. Independent restaurants can apply this by owning it when they launch new dishes that weren't popular. If you launch a dish that turns out to be a flop, you can tell your regulars who tried it but didn't really like it, something like, "I know our new birria tacos dish was pretty mediocre and I'm sorry for that. What do you think we should do to improve them?" Or what other ideas do you have for dishes that you'd like to see on the menu? Especially in an industry where chefs are known to be egotistical and arrogant and take offense when somebody doesn't like their dish, it's refreshing to the guest when people are honest and they admit mistakes and they admit things are imperfect. And it makes them more likely to like you and to like your restaurant and to give you feedback, which you can then use to succeed like Domino's when you admit your mistakes. In my company, I've done this exact strategy in acknowledging the parts of our platform that are weaker and then asking for feedback. And I've found that it leads to this incredible trust because of the pratfall effect. There's another key psychology hack that they've used for incredible explosive growth, and this is probably the biggest one underpinning their growth. But before we cover it, I've got a quick favor to ask of you. If you found this video interesting, then click that subscribe button down below to make sure you don't miss the future breakdowns that I create on the latest and greatest in growing a restaurant business. In helping thousands of restaurants grow over the past 5 years, I've learned a lot about restaurant marketing, which I share in weekly breakdowns here on this channel. Psychology hack number 4 is gamification. Using their loyalty program specifically. Domino's loyalty program is a form of gamification that rewards customers for repeat business. It makes it fun, rewarding, and even addicting to spend money with them, just like a game. This is a part of the reason why over 70% of Domino's total business now flows through their online ordering systems. By the way, it's not just Domino's that's utilizing a rewards program and the psychological benefit of it. There's a reason almost all of the top 50 restaurants by revenue in the entire United States have this in common. At least 48 out of the 50 have a rewards program in place. A famous study published in the International Journal of Hospitality Management in 2011 showed that loyalty programs not only increase the average check size because they make people feel like they're getting better value, therefore they're willing to spend more money, but it found that free rewards from loyalty programs also increase positive reviews, the likelihood to share the restaurant via word of mouth, and it increases the frequency of orders for regulars if it's set up properly. Rewards programs play on another important psychology hack, the idea of reciprocity, which brings us to psychology hack number 5, using reciprocity to increase cart size and regular loyalty. Reciprocity is this idea in psychology that we as humans have a desire to help people who first help us, who first give us stuff before they ask. Domino's uses it brilliantly by giving people free food as they're going through the ordering experience, which makes them more likely to say yes when they ask them if they want the upsells on the menu. In 1971, there was a scientist named Dennis who created a famous study that proved why reciprocity is so effective as a marketing strategy and as a business strategy. He wanted to learn more about why people do nice things for others. He thought that if somebody does something nice for you, you might feel like you need to do something nice for them too. So he created an experiment to prove out this idea. In that experiment, he invited people to look at some art and told them they would be working with a helper. Then during a short break, the helper gave the person a free soda for the break, or they did nothing at all in the other half of the cases. Then after the break, the helper asked the person who was in the experiment to buy some raffle tickets for a good cause. The person had no idea that that was a part of the experiment. But Dennis, the scientist, wanted to see if people who got a free soda from the helper would buy more raffle tickets when they were asked, compared to those that didn't get anything from the helper at all. And guess what? The people who got a free soda from the helper bought more raffle tickets by more than double. Dennis learned that when somebody does something nice for you or gives you something for free, you're way more likely to do something nice for them in return when they ask, even if you didn't ask for the favor in the first place. So you can see why as a restaurant, when you're giving regulars free items through a loyalty program every 2 or 3 orders, that it not only makes them feel good, but it makes them spend more money and more likely to order from you again, and more likely to leave you a positive review when you ask. It overall builds this incredible goodwill with the customer base that you can use in multiple ways. Speaking of reciprocity, Now that I've given you 5 awesome psychology hacks that you can apply in business, I have a small favor to ask in return. I think you see what I did there. But if you've enjoyed this so far, then click that like button and take just 15 seconds to comment down below which of these psychology hacks that we've covered so far you've found the most interesting. Anyway, back to the video. That brings us to psychology hack number 6, the power of expectation setting. We all know how much humans, especially younger humans in Gen Z and millennials, love convenience. It's something that they just can't live without, speaking from my generation, Gen Z. But there's nothing more inconvenient when you order food than having to call the restaurant multiple times to get updates on where it is, or like make sure it's still coming because it's been 45 minutes and they said 20 minutes. So Domino's famously were the first to invent the solution to this one, the automated driver tracking on their app and the status updates that you get after you place an order so that you always are in the loop and always have your expectations properly set about when the food is gonna arrive. Now, this has become the standard not just in Domino's, but in DoorDash's business and Uber Eats' business. And there was a study published in 2016 in the International Journal of Logistics Research, which proves scientifically why this is so important to consumers. In 2016, 3 researchers wanted to find out what happens when online shops tell customers how long it will take for their orders to arrive. They also wanted to know how long people are willing to wait for the orders before they become unhappy, and the effect that expectation setting had on their overall levels of satisfaction. When shops gave accurate estimates of when the orders would arrive, people were actually more satisfied than with shorter times that were quoted as being even shorter. So if the shop said it'll be there in 1 day and then it took 2, they were more upset than if the shop said it'll be there in 3 days and it took 3. In an interview I saw with the head of data analytics at Domino's, he stated the exact same study and said that they ran one just like it internally, where the #1 most predictive factor in whether people reordered from Domino's online was the accuracy of the quote time that they got. So if your restaurant doesn't already do live driver tracking and status updates to make sure that guests' expectations are always properly met, then I highly recommend finding a solution which does do that, because it creates a 10 times better delivery experience. This feature is also key for getting customers to order from your website or your app instead of delivery apps like Grubhub and Uber. Anyway, convenience and expectation setting aside, there's one more major psychology hack that Domino's uses to increase sales. That's psychology hack number 7, using scarcity to drive sales. Scarcity is when there's a limited amount of something, and it makes people want it much more. People want what they can't have. That much is obvious. Domino's uses scarcity constantly by having a deals page on their website and their app that they're constantly switching around, and notifying people on their email list or text list about the new deal that they're running this weekend for the Super Bowl. It gives people a constant, clear reason to act that they're going to lose if they don't move forward. It drives scarcity because it's a limited time offer, and it helps them push specific menu items and limited time promotions. For example, they might offer a discount or special pizza that is only available for a limited time. It's that urgency that gets people to buy items which they otherwise wouldn't, because they feel like they're going to miss out and lose the item, lose the opportunity unless they move forward in the limited time that they have. This one is simple and obvious, but super powerful to use, which is why I've got a bonus for you. I know you were thinking, Adam, give us an encore. I know I promised 7, but I like to under-promise and over-deliver. So here's a really important one to finish off this video that I know Domino's also uses. Bonus psychology hack number 8 is social proof to attract new customers, and how they get that social proof is reciprocity. Because when you first place your online order on their app, they show you how many loyalty points you have. So what a pleasant surprise. I just placed a $30 order and got 300 slice of the pie points, which is what they call the rewards program. Then, shortly after giving you points, they ask you for a review. This is brilliant, and it's how they've built up to 7 million reviews on the app stores, which then leads to getting more customers. Why is it so powerful? Because according to data from Grubhub, 70% of people reference online reviews when deciding whether to order from a restaurant and what to order. And they're not just referencing review content, they're referencing how many reviews there are and what the average star rating is. So if you give somebody something for free, like rewards points, right before you ask them to give you a 5-star review, Is it reasonable to assume they'll give you a 5-star review more of the time? Yes. Yes, it is. And that's what Domino's does. That's how they have 7 million reviews on the App Store, because as we saw from the reciprocity idea we covered earlier, they're that much more likely to comply with an ask once you give them something for free. By the way, our platform at Owner.com has a feature that integrates with the online ordering system and does this automatically, sending people a text and an email 2 hours after their order is complete, asking for feedback and telling them about how many points they got. Then asking them if the feedback was positive to post that positive review online. It drives incredible results for restaurants because people want what people want. When they see a lot of people giving something very positive reviews, they're significantly more likely to buy it. It's just part of human nature, and it's something you can use to your advantage in combination with reciprocity and asking for reviews after you've given something of unexpected free value. Okay, so that's the end of this video on Domino's. But if you want another video which breaks down the marketing superpowers that restaurants get from having their own branded mobile app, which Domino's certainly has done, and we have more Domino's examples in that video, then click to the right of me right now. I'll put it on screen. In that video, I share real data from real restaurants, the before and afters they've seen in terms of sales, in terms of frequency, in terms of transaction sizes, so that you get more context on why mobile apps are so important for restaurants. Hope again that this video was useful to you, and if it was, then please click that like button and that subscribe button down below. It would truly mean a lot, and make sure that you never miss out on the videos that I post here on this channel about the latest and greatest in growing a restaurant business.